The IRS will penalize you 25% for not taking money out of your own retirement account. Not for hiding money, not for underpaying taxes, for leaving your own money alone. That is the required minimum distribution rule. And right now, in 2026, millions of seniors either do not know it applies to them at age 73, or they know it and still cannot name the one form that makes the penalty disappear. There are 7 mistakes retirees make with required minimum distributions. The IRS changed the penalty structure in 2022, changed the starting age in 2023, and changed the inherited account rules in 2020. Most people still operate on the old numbers. This video goes through all 7, including the one form that cuts your penalty by 60% if you use it in time. If that is information you want to keep, subscribe and turn on notifications. The IRS will not send a reminder. Neither will anyone else. Before mistake number 1, consider what happened in January 2023. Hundreds of thousands of Americans who turned 73 that year had spent years planning around a different number, 72. That was the age that triggered required minimum distributions under the old law. They had written it down. Their advisors had confirmed it. The account statements reflected it. Then, Congress signed the Secure 2.0 Act on December 29, 2022, 4 days before the new year, and the trigger age jumped to 73, effective immediately. No press conference, no mailed notice. The Social Security Administration sent nothing. The custodians holding those accounts issued no automatic alert as policy. Silence. The kind that settles into a room after a door closes and nobody realizes anything changed. Those retirees did what made sense based on everything they had ever been told. They waited 1 more year. They left the money untouched. They felt fine about it. They owed a 25% excise tax on every dollar they failed to withdraw. For retirement accounts averaging between $200,000 and $400,000, the range that describes most of that cohort, a missed required minimum distribution carries a penalty between $1,200 and $4,000 per year per account. The IRS does not call. It does not write. It calculates. And when you eventually file, the excise tax is already sitting there, attached to Form 5329, which the IRS also never mailed you. The thing is, if you have a parent who turned 73 in 2023 or 2024 and still believes the old age 72 rule applies, the window to correct this without the full penalty is still open. But not indefinitely. That correction window has a hard edge. You will hear exactly how long it lasts before this video ends. Mistake number 1. The age changed. Most retirees do not know. Under the Secure 2.0 Act, signed December 29, 2022, effective January 1, 2023, the required minimum distribution starting age moved from 72 to 73. That is the rule today, and it moves again. In 2033, the starting age rises to 75. 2 more years before withdrawals become legally required. For someone managing a Roth conversion strategy or trying to stay below a Medicare premium threshold, that additional runway is worth real money. But look at what the financial services industry spent 15 years doing. Seminars, brochures, software defaults. Begin your RMD at 72 is embedded in the memory of an entire generation. Clients who had already adjusted once when Secure 1.0 moved the age from 70.5 to 72 back in 2020. 3 years later, before many of them had taken a single distribution, the age changed again. The IRS updated Publication 590-B, APDF, on a government website. That is the disclosure mechanism, the institutional equivalent of a correction notice printed in the back of a newspaper nobody reads anymore. Most retirees trust the institution holding their money to notify them when something significant changes. That trust is completely reasonable. It is also costing people money. In 2026, right now, in accounts that have not taken a distribution, they legally owe. Mistake number 2 is subtler, in some ways more expensive. The law offers a one-time delay. If you turn 73 this year, you are technically allowed to postpone your first required minimum distribution until April 1st, 2027, not December 31st, 2026, April 1st of the following year. On paper, it sounds like a buffer. A few extra months for the account to grow. Time to plan the withdrawal with more precision. It is a trap with a clean surface. If you push your first RMD to April 1st, 2027, you still owe your second RMD for 2027 by December 31st, 2027. 2 full distributions, same calendar year, both taxable as ordinary income, both landing on the same tax return, stacked on top of each other, both counted when the IRS calculates your modified adjusted gross income for that year. Both potentially shoving you into a higher federal bracket, both potentially triggering the IRMAA surcharge, the Medicare Part B premium increase that activates at $103,000 for a single filer, which adds $185 or more per month to what you pay for coverage you already have. 2 distributions in 12 months. The delay option is technically legal and technically a mistake. The fix is simple. Take the first distribution in December of the year you turn 73. 1 per year, steady, no stacking. The April 1st extension exists in the tax code as a grace period for edge cases, not as a planning strategy. Thousands of seniors use it every year on the advice of professionals who explain the option without fully explaining what it costs. That is 2 mistakes. 5 remain. And honestly, the one that does the most damage is not a penalty at all. It is a benefit that almost nobody uses the right way. There is a direct transfer mechanism written into the tax code that can satisfy your entire RMD obligation and remove that income from your taxable gross entirely. Most bank advisors have never mentioned it, and the form at the center of everything, Form 5329, is the document that either cuts your penalty or eliminates it, depending on how fast you move. How fast is fast enough? So far, the required minimum distribution starting age is 73, not 72. Delaying your first distribution to April 1 forces 2 fully taxable withdrawals into a single calendar year. 2 mistakes. Hundreds of thousands of people made at least one of them in 2023 and had no idea. But nobody in this industry has satisfactorily explained why the same law that reduced the excise penalty from 50% to 25% also hid a second mechanism, one that cuts the penalty again, down to 10%, inside a form the IRS never sends you. That form exists. That reduction is real. And the window to claim it closes in exactly 2 years from the date of the missed distribution. Most people find out about it on year 3. Before mistake number 3, there is a story that does not involve a penalty at all. It involves a death and an inheritance and a 10-year clock that starts ticking the moment the paperwork clears. A woman in her late 50s inherits her mother's traditional IRA. The balance is $230,000. The financial advisor at the custodian tells her, correctly, that under the Secure Act of 2020, non-spouse beneficiaries must fully liquidate an inherited IRA within 10 years of the original owner's death. She nods. She understands. She thinks, 10 years is a long time. She leaves the account untouched. The money grows. Year 1 passes. Year 3 passes. The advisor changes firms. A new advisor comes in and says nothing because the file looks clean. There is money in the account, no penalties flagged, no letters from the IRS. Year 9. The account is now worth $290,000. Year 10. She owes income tax on the full remaining balance, in a single calendar year, on top of her existing income, at whatever marginal rate that combination produces. There is no distribution schedule, no way to spread it. The law gives you 10 years to plan, and most beneficiaries spend 9 of them not planning at all. That is the universal version of this story. A windfall becomes a tax event because nobody explained that the flexibility in years 1 through 9 is not actually flexibility. It is a countdown. And the thing that makes it a tragedy is not the tax rate. It is that the math was always there, sitting in the same document the advisor handed her at the beginning, and nobody read past the first page. Mistake number 3 is the penalty itself. Specifically, what most people are not told about how to make it smaller. Under the Secure 2.0 Act, signed December 2022, the excise tax for missing a required minimum distribution dropped from 50% to 25%. That is the number you will hear from most financial professionals, 25%. That is the number listed first in most publications. That is not the number you want to pay. Inside the same legislation, under Internal Revenue Code Section 4974, there is a correction window. If you missed a required minimum distribution, take the missed amount within 2 years of the deadline and file Form 5329 with a reasonable cause statement attached. The excise tax drops to 10%. Not 25, 10. On a missed distribution of $30,000, that is the difference between paying $7,500 and paying $3,000. Same mistake, same year, different form, different outcome. Honestly, the reasonable cause waiver goes further than that. A properly structured waiver request, attached to Form 5329, specific in language, documented with supporting facts, can reduce the penalty to 0. Not 10%, 0. The IRS has the discretion. It uses it. The Internal Revenue Manual describes exactly what a qualifying reasonable cause statement contains. The IRS has never published a press release about this. There is no FAQ on irs.gov titled, "How to Eliminate Your Missed RMD Penalty." The mechanism sits in the code, available to anyone, disclosed to almost no one. Here is what makes it worse. Form 5329 is not mailed. It is not generated automatically by the custodian holding the account. It is not triggered by anything the brokerage does. You, the account holder, must attach it manually to your Form 1040 for the year the distribution was missed. You must write the reasonable cause statement yourself or have an advisor write it. You must file it on time. And you must know it exists in the first place. The IRS has collected excise taxes from retirees who qualified for a full waiver. They paid because nobody handed them a form, and nobody explained that the form was optional in the first place. That is 4 mistakes, 2 wrong ages, and 2 buried mechanisms inside the same law. The next 3 mistakes are different. They are not about age cutoffs or penalty rates. They involve a specific category of account that the Secure Act fundamentally redesigned, and where the rules now work in a way that is almost directly opposite to what most beneficiaries believe. But the piece that most people miss entirely is not a mistake. It is a strategy. One that exists inside the tax code, reduces your taxable gross income by the full amount of your required minimum distribution, and has been available to anyone over 70 and a half since 2015. Most retirees have never heard the name of it. And the people who have heard the name, most of them are using it wrong. There is a version of this rule that almost nobody tells working seniors, not because it is complicated, because the people who know it assume you already do. Mistake number 5. 73 years old, still employed, still contributing to the company 401k. The rule says required minimum distributions start at 73. Most people assume that means them. It may not. The still working exception allows an employee who owns less than 5% of the sponsoring company to defer RMDs from that specific employer's 401k until April 1 of the year they separate from service. The distributions are not forgiven, deferred. But deferral has real value. The account keeps growing tax-deferred, the income hit comes in lower-earning retirement years, and the timing stays under control. The 5% threshold is the hard line. Own 5% or more, directly or through family attribution rules, and the exception disappears. Own 4.9, it applies. The IRS calculates it precisely. Here is the part that costs people money. The exception covers only the current employer's current plan. It does not touch IRAs. It does not apply to a former employer's 401k from 2014. It does not apply to a second jobs plan, a side business, a spouse's former employer. Every IRA follows standard RMD rules at 73, regardless of employment status. Only the active employer's active plan qualifies. Seniors still working at 74 or 75 often assume the exception covers everything. It covers one account. Now the injustice, and that word is precise. There are retirees who paid the full 25% excise tax on a missed required minimum distribution and discovered Form 5329 afterward, not years later, sometimes months. The return was filed, the penalty paid, the check cleared. Then, in a conversation with a different advisor, or in a forum, or in an article found by accident, they learned that a 2-year correction window existed, that a reasonable cause waiver could have reduced the penalty to 0, that the IRS had the discretion to forgive the entire amount and in documented cases had done exactly that. The money was gone. An excise tax paid voluntarily after the correction window closes cannot be reclaimed by amendment. There is no appeal on the grounds that the advice was incomplete. The version of this story that appears in financial forums is always the same shape: a retiree, a penalty in the thousands, a form nobody mentioned, a window that closed before anyone said the word waiver. The cruelty is not IRS aggression. The cruelty is that the information was always public, always documented in Publication 590-B, and never handed to the person who needed it at the moment it mattered. Mistake number 6. Aggregation. Simple concept, costly distinction. Multiple traditional IRAs. Calculate each separately, then take the combined total from any single IRA or any combination. One account, all accounts, any split. The total must be correct. The source does not matter. 403B plans follow the same logic. 401k plans do not. Neither do 457B plans. Each qualified employer-sponsored plan outside the 403B category requires its own separate calculation and its own separate distribution. Pulling double from one 401k does not satisfy a second one. The IRS does not accept cross-plan satisfaction for qualified plans. The retiree holding 2 IRAs, a 401k from a former employer and a 403b from a teaching position 20 years ago, has 4 separate calculations, 2 different aggregation rules, and a penalty structure that treats each missed distribution as its own event. Most tax software handles this correctly if the data is entered correctly. Most retirees do not know what to enter or why the categories matter. IRS Publication 590-B documents all of it. It is also 47 pages long and written like a regulatory filing, not a conversation. 6 mistakes. 2 wrong age assumptions. 1 calendar trap. 1 buried form. 1 exception that covers less than most people think. 1 aggregation rule that most software requires you to already understand before it can help you. The 7th mistake is different in kind from all of them. Not a penalty, not a form, a strategy. One that legally removes the entire required minimum distribution from taxable gross income written directly into the tax code available to anyone over 70 and a half since 2015. Most seniors either do not know it exists or are executing it in a way that makes it invalid. The way it gets invalidated is almost always the same. 1 step, done in the wrong order. That order matters more than the amount, more than the account type, more than anything else covered so far. And almost nobody explains why until after the mistake is already made. The 7th mistake is not a penalty. It is a missed opportunity, the largest one on this list, and the mechanism has been sitting in the tax code since 2006. A qualified charitable distribution allows an IRA owner aged 70 and a half or older to transfer up to $105,000 directly from a traditional IRA to qualifying 501c3 organizations per calendar year. The transfer counts as the RMD and is excluded from gross income entirely, not deducted, excluded. It never enters the taxable income calculation. It reduces modified adjusted gross income by the full transferred amount. The charitable deduction the tax code already provides reduces taxable income after it is calculated. The QCD exclusion removes the income before the calculation begins. For seniors near a bracket threshold or near the IRMAA line, that distinction is structural, not cosmetic. Medicare Part B charges a base premium of $185 per month in 2026. Above $103,000 of modified adjusted gross income for a single filer, a surcharge applies, tiered, compounding, recalculated annually. A retiree whose MAGI sits at $108,000 pays that surcharge every month. A qualified charitable distribution of $10,000 or $15,000, money they were planning to give anyway, can move MAGI below the threshold entirely. The surcharge stops. The savings repeat every year the income stays below the line. Most bank advisors never run this calculation. Now the step that invalidates everything. The custodian mails a check to the account owner. The owner deposits it, then writes a personal check to the charity. That sequence, logical, intuitive, permanently disqualifies the qualified charitable distribution. The distribution becomes fully taxable ordinary income. No amended return recovers the exclusion. No grace period applies. The check must be made payable directly to the charity, issued by the custodian, and never touch the owner's hands. One step, done in the wrong order, and the most valuable tax tool available to seniors over 70 and a half is gone permanently. There is a retiree who discovered the qualified charitable distribution at 74, 2 years after her husband passed, managing her own IRA for the first time. She had been giving to the same 3 organizations for 11 years. Her new advisor set up a direct transfer. The custodian issued checks payable to the charities. Her MAGI dropped below the IRMAA threshold for the first time in 6 years, and the Medicare surcharge she had been paying, over $3,000 per year, stopped. She told her daughter the money felt like it was doing 2 things at once. The following year, she increased the transfer. That is what the system looks like when it works. Not a loophole, a mechanism in the tax code that rewards intentional planning with real, repeating savings. The gap is not between clever people and everyone else. It is between people who were told and people who were not. 7 mistakes. Here is the full map. 1. The RMD starting age is 73 under Secure 2.0, effective January 2023. It rises to 75 in 2033. Hundreds of thousands of retirees who turned 73 in 2023 missed their first distribution because nobody updated them. 2. The April 1 delay forces 2 full taxable distributions into a single calendar year. Bracket creep, IRMAA exposure, no recovery. 3. The missed RMD excise tax dropped from 50 to 25% under Secure 2.0. A 2-year correction window reduces it to 10%. A properly filed reasonable cause waiver on Form 5329 can reduce it to 0. Most people pay 25% because nobody mentioned the form. 4. Form 5329 is never mailed. The account owner must attach it manually to Form 1040 for the year of the missed distribution, write the waiver statement, and file within the correction window. That is entirely the filer's responsibility. 5. The still working exception defers RMDs from a current employer's 401k for employees who own less than 5% of the company. It does not apply to IRAs, former employer plans, or any other account. 6. Multiple IRAs may be aggregated and satisfied from any single account. 401k plans may not. Each requires its own separate distribution. Incorrect filing across account types generates separate penalty events per plan. 7. The Qualified Charitable Distribution removes up to $105,000 from taxable gross income, satisfies the full RMD, and can eliminate the IRMAA surcharge. The custodian check must be payable directly to the charity. If the owner receives it first, the exclusion is permanently disqualified. Before you go, subscribe and turn on notifications so the next change does not catch you off guard. And share this video with someone you know, a parent, a neighbor, a friend on Social Security or Medicare. They probably have not heard any of this either. I'll see you in the next one.